Good day, Junior Techie. This is Mr. Malone speaking, and today we are going to look at the year-end procedures, and specifically, we're going to look at the first one regarding depreciation. Now, first of all, you want to ask me, what is depreciation? Now, depreciation is the loss in value of an asset over time. And now, when we calculate depreciation, we have two methods of calculating depreciation. And that is the fixed installment method or the diminished balance method. Now, you can also refer to the fixed installment method as the straight line method or the cost price method, and the diminished balance method is sometimes referred to as the book value method. Now, the fixed installment method is also referred the formula is very straightforward. It's cost price over 1 times rate over 100 times months over 12. Now, it's very important to have the months over 12 here, because we can buy an asset at the beginning of the year, during the year, or on the last day of the year. And it is important to always depreciate for the entire time that you own the asset. So if you only own it for part of the year, you can only have or calculate for part of the year. And then lastly, the formula for diminished balance. Now, diminished means to diminish or to make less. So the formula, you must remember it that way, must minus off the accumulated depreciation. So you're going to take cost price minus accumulated depreciation times rate over 100 times months over 12. And that's your formula for the diminished balance method. Then, how do we record depreciation? Now, depreciation is an expense. Now, the big word for it is called an imputed expense. And all that means is that it is an expense that records a loss in value and is not physically paid in cash. So it's not a cash expense that you pay. You don't pay depreciation to any specific person, but you have to record the loss in value of the asset for the business for that specific time period. And that is why we record it as an expense, or that loss in value for the year as an expense for the year. And then we have to create a new account to record the total loss in value over time. And we cannot put this straight into the vehicles or the equipment account, because the historical cost principle applies. And that means that we can only record the cost price in our fixed asset accounts. And that is why we create a new account, accumulated depreciation on equipment or on vehicles. It's two accounts basically, one specifically for equipment, one specifically for vehicles, to record the loss in value for equipment and for vehicles over the entire lifespan of that asset. Then, so that is now what we call a negative asset. So it is an asset, but it will minus because it's the loss in value. So going forward and looking at an activity for all of this. Activity 1, Mr. Dean Jefferson, trading as DEJ Traders, started his business on the 1st of March 2019. On this date, he bought a second-hand vehicle for 260,000 Rand and equipment for 91,000 Rand. He paid by EFT for both these items. So in other words, he paid cash for them. So the contra account must be bank. And at the end of the financial period, we have to depreciate both these assets and we have to do it for vehicles at 20% on the fixed installment method, and equipment on 15% per annum on the diminished balance method. And then they ask us to make the journal entries to record the depreciation for the year. Now, depreciation will always be recorded in the general journal, because all year-end transactions will go into our general journal because it's a non-cash item. And then finally, show the relevant ledger accounts. We do not need to balance or close off the accounts. So first, the calculation. So if we calculate for vehicles, they ask us 20% per annum on the fixed installment method. Therefore, fixed installment means cost price method. So our formula is cost price over 1 times rate over 100 times months over 12. So let's fill it in. The cost price of the vehicle was 260,000. 20%, so that's our rate, 20 over 100. And we bought it on the first day of the year, so 12 months. And if we then calculate, we get 52,000 Rand loss in value for the vehicle at the end of the year. Moving on to equipment. So we have equipment at 15% per annum at the diminished balance method. Diminished means, remember, to minus off or to make less. So our formula has to change. So cost price minus accumulated depreciation over 1 times rate over 100 times months over 12. Now this accumulated depreciation must be the opening balance for accumulated depreciation for the entire year. Now because it's a new, not the entire year, for the entire lifespan of the asset. Now, because it's a new asset, there is no accumulated depreciation. So we can't minus anything off because it's the first time we calculate depreciation on this asset. So it's minus 0 times 15% times 12 over 12. And that gives us 13,650 Rand. Now we need to record this in the general journal. Now, in the general journal, we are going to debit depreciation. Why? Because that is our expense increasing for the year, recording the loss in value for the asset or assets for this year. And then we have our accumulated depreciation on vehicles. Oh, before we continue there, remember that this depreciation records the loss in value for all assets. So I have to take the 52,000 plus the 13,650 to get the total loss in value for depreciation, 65,650. And then our accumulated depreciation on vehicles only records the vehicle part of 52,000. And as we said, it's a negative asset that has to increase. So it's a credit that pluses, or a minus that pluses, which gives us a total minus, if you remember your maths. And again, accumulated depreciation is a negative asset that increases for equipment, and now we take only the value for equipment, 13,650. And your narration must always just include the rate and the method. So you're going to say vehicles, we recorded depreciation at the end of the year for vehicles at 20% per annum on the fixed installment method, and for equipment on the 15% per annum on the diminished balance method. Then we have to now record this in the general ledger. So if we look at the general ledger, remember that vehicles and equipment can now only record the cost price because of the historical cost principle. So now we bought it on the first day of the financial year. So we have to say bank CPJ, not balance, because it's not a balance we bring down. It is a recording of the purchase of the asset. So March 1st, bank CPJ is 260,000 Rand. How do I know it's bank? Because he paid via EFT. And then equipment, also a fixed asset. Yet again, same thing happened. We bought it on the first day of the year. March 1st, bank CPJ 91,000. Now, to record the accumulated depreciation on vehicles, we must remember that this is a loss in value. So it's a negative asset. So it is going to minus plus, but we have to credit minusing the value. So it's an accumulation of a minus. So the minus will become more and more. Importantly, we take the end of the year date because this is year-end adjustments, and we only record depreciation at the end of the financial year. So 2020, February 28th, depreciation, General Journal, 52,000 Rand. And now we have to do the same for accumulated depreciation on equipment. Yet again, we record a loss in value. So it's a negative asset that must increase. So we're going to credit. So yet again, depreciation on the last day of the month. So we are going to, not the last day, so we use the end of the year balance because it's an end of year transaction. So depreciation, General Journal, 13,650. Then the nominal account section, depreciation, is an expense. So we have to record the total loss in value for all the fixed assets in the current year in our depreciation. So the credit account was the accumulated account, and now we are to debit depreciation. So first, we're going to debit for accumulated depreciation on vehicles, 52,000 Rand, and then we're going to debit for accumulated depreciation on equipment for 13,650, and then we add it to show that the total depreciation for the financial year is 65,650. And that is how we record depreciation. So remember, depreciation is the loss in value over time of an asset, and we are going to next video still look at depreciation, but a slightly more challenging activity. Thank you and goodbye from Mrs. Tamela.